Dog Trading video newsletter. Now today we're going to talk about something we haven't talked about for a while, and that is the Eagle Eye style of trading. And I've had a few people write in some questions about this recently, so that's great. And oh, by the way, that also reminds me, I wanted to tell you that don't forget that as a subscriber to the video newsletter, you get the opportunity to send in questions. Well, everyone can send in questions via email, but if your question is regarding something that I feel would be advantageous and beneficial to all, or at least the majority of our video newsletter subscribers, and it's something that I do personally or I know about, then I will answer the question in a video in one of these video newsletters instead of just a written email response. And obviously a 15-20 minute video response is much better, much more clear. I can go into more detail and give you a much more exhaustive response. So don't forget about that, and send those questions in. I love to make sure that way I know I'm on giving you guys what you want and the type of information you're looking for. So I love it, love it, love it when you do that. Do not be shy about it. Okay, so anyway, along those lines, we have had a few people send in requests about the Eagle Eye approach. So happy to do that. I love the Eagle Eye approach personally. Just quick little review to remind you what it is. What the Eagle Eye approach is, we've got 3 time frames here. All right, so it can be any markets and any time frames here basically. But when I trade the NQ, which actually I think the NQ is a good market to start with. It's a $5 contract, so it's rather inexpensive. But then when you get better at trading and you're more consistent in your profits, then you may want to look at a more expensive market like the E-minis, because then commissions are less of a percentage drawdown of your profits. So anyway, but the NASDAQ 100 is a very good market to trade. So it moves very well, and a lot of volume and so forth. So looking at this, when I do trade it, these are the time frames I use. These are not necessarily the best time frames. There are no best time frames, but these are the ones that I personally like. So as you can see on the left, 200 tick chart, then we multiply that by 3, so we call that our short-term chart. Multiply that times 3, we get our 600 tick chart. We call that our medium-term chart. And then on the far right, multiply the 600 times 3, we get 1800 tick chart. So there's a 3-to-1 ratio between each of the 2 charts that are next to each other. So the 1800 tick chart we call our long-term chart. Now, 3 styles of trading that I cover in my foundations courses. Really quite simple, just basically scalping approach. We are using the short-term chart for our setups. Cherry picking style, we're using the medium-term chart for our setups. And for the Eagle Eye, we're using the long-term chart for our setups. We're looking for setups on the long-term chart. So that's just a brief description of those 3 styles of trading. All right. So we're looking for a setup over here on the Eagle Eye. And what do we have? Do we have one? Well, yeah, we've got. We'll look at this one here. So what we've had is a wave 7. Actually, I'm going to turn this off for a second. We've had a wave 7. Okay, so that's our first extended wave in the trend. 5 is average, 7 is next. We come down, boom, make a little higher high on price, but in order to put in an actual wave 9, we would need to have a real body above the high of this bar. So just for clarification here, again, I've received some questions on this, so I'm going to answer this one right now. Okay, so there's the high of wave 7. So we do make a higher high, but when I talk about the qualifications for a complete wave 9, for it just to be a pure 9 and not a failed 9, this is a failed 9, we'd have to have the real body, which is the colored area, green or red, has to be above, equal to or above the high of wave 7. Now you can have part of the wick below it, the lower part of the real body. See the real body and this bar is that green part. The real body on this bar is that green part. The real body on this bar is the red part. So we would have to have a candlestick where the real body would be above. Now, the bottom of the real body can be equal to the high. Okay, and then we got some wicks or whatever up here. Or higher. Then that would be a 9, but that's not what happened, right? So that's why that's a failed 9. So I kind of like that. Second of all, it's, what I like is that, we had our wave 7, but then we had a retest of that wave 7, and it's failed. In other words, we went up here, and maybe there was a little stop running up here. Great. That's a stop running type of pattern. Now, we never know when the actual intention is to run stops or whatever, but that's the stop running pattern that we look at. Then so this retest fails, which is very important. Stops are taken out. We've got a very nice spike top reversal candlestick pattern, which often we use that to confirm cycle highs, especially when we just have a cross of K and D. In addition, so we got a cross of K and D there. In addition to that, we've got a first cycle high after dad turns down. So we have a trend reversal trade and a momentum shift trade. So concurrent setup. So that's great. All right. So that's the reason for the trade. That's what we're looking at. Okay. Now, how do we trade this? Well, basically, before I do that, turn off these global crosshairs quickly and just say what we need is on the medium-term chart. This would be our confirmation chart now. Normally, we look for a confirmation on the next higher time frame, but in this case, in the eagle eye, we actually look for it on the medium-term chart, and we look for it in the exact same way that we do when we're looking at a higher time frame. Primarily, since we're looking to go short, we're doing a trend reversal trade here. After an extended trend, we're looking for mom to be going down, number one, most importantly. And then, if the cycle indicator is somewhere in the middle of the range, then we're also looking for that to go down. If it's at the bottom, then it's meaningless. Okay, so that's confirmation. And then our trigger is on the shortest term chart. And all we need is a cycle high. Okay, basically a cycle high, hook down, and we do our normal entry, one tick below the low of the bar that created the hook down on K. Now, we will also look at these charts to see if we get any setups. Okay, that's advanced trading. You don't have to have it. You don't even have to look for it. In Foundations 1 and 2, we don't teach you to look for that. In advanced trading, we teach you to look for setups on all three charts concurrently at the same time. So, yeah, I do look for that, but you don't have to. Basically, the short-term chart is just our trigger chart, and all a trigger is simply putting in a cycle high. And we'll look for any other clues we may get. Okay, so now let's bring up our global crosshairs. And let's see what kind of alignment we get here. All right. So, yes, right here. All right, so we get a cycle high here on the short term. Now, is there any good setup there? No. There's no setup on the short-term chart, but we get an engulfing candlestick pattern. K doesn't quite get up to 80, so again, it doesn't perfectly meet our rules. You'd have to fudge it a little bit depending on how good everything else looks. So that's pretty much it. There's no great setup or anything. We just get a trigger. Medium-term chart, we have confirmation. Mom's angling down. D's angling down. K's actually angling up. On the long-term chart, we've already covered that. We've got a lot of good stuff over there. Okay. Now, if you decided, let's say that you decided on the short-term chart, I want to show you a couple different things unique to the eagle eye trading style. Okay, so let's say you decided, I'm not comfortable taking this cycle high. You could wait maybe for this one. You can wait for the next cycle high. Now, is that still a valid trade? Yeah, it is, but it's definitely not as good, is it? Definitely not as good. And of course it's not as good. Normally it's not going to be as good unless it comes all the way back up and retests the high. But that's going to be pretty unlikely here. Point is, you will get several cycle highs on the short-term chart within the same cycle high on the long-term chart, because the ratio there is 9 to 1. So you will sometimes get a second opportunity to get in. Now, sometimes that'll be a good opportunity because the second high will be close to the first high. Other times it won't be a great opportunity. This time, not so great, because you're getting in much later. The market has moved down a lot since that last time. So the trade is still valid. You could take it, but definitely not as good. All right, so let's go back to the first one, because that is our best opportunity. And so our entry is our risk. The nice thing is, with all three of these styles, though, the risk is always the same on all three styles. So with the Eagle Eye, you see your reward is based on the longest term chart, but your risk is still defined on the shortest term chart. So our risk over here in the 200 tick chart, we're entering one tick below the low of the bar, this bar, and our stop goes one tick above the high of that cycle high. That's it. So risk is the same. Reward, we're looking for a big, hopefully a big reward. Now, will it happen? We don't know, but the potential reward is bigger. I mean, ultimately, we would love to see a full 5-wave downtrend on the 1800 tick chart. Now, probably not even enough time for that to happen in the day, but at this point. But that would be, the ultimate. How often is that going to happen? Not too often. Also, the other thing you have to realize is the retraces on the 1800 tick chart are going to cover a lot of price. So you'd have to be able to withstand a lot of movement against your position if you're going to trail on the cycles or the swing highs of the 1800 tick chart. But anyway, there's another lesson here to be learned, so let's just go on with it. Okay, so we enter below that. Okay, cycle high. Okay, everything's still looking good. Another cycle high. Whoops. Let's just do this here. Okay, comes back down. Okay, we come back up here. Now, are we still okay with this trade? Yeah, we're still okay with this trade. Why? Well, because everything still looks good. We've got, actually we've got kind of a reload pattern, a bit of a reload pattern on the short-term chart. It's kind of a weird one. But we do have one, 5-wave up on mom and 50 amazingly down. So this actually looks pretty sweet. Medium-term chart, cycle high, first cycle high after dad turns down. That's great. Over on the 1800 tick chart, things are still going down. Mom is still down. We've got a nice engulfing candlestick pattern over there. We've broken down below the 15 EMA on the long-term chart. Cycle indicators inconsequential down here because it's at its low. Okay. We keep going down, down, down. Make another lower low. Now what do we have? Okay. This is interesting. Oh, I see. Yeah, that went flat there. So now we have. Here's what I want to show you, because we're running out of time now. I gotta squeeze my chart up here to show you this. I already know what happens here. I've planned this for you guys. Okay, I need you to see the big picture here is what I need. So let me squeeze this chart a little bit. Okay. Yeah, since we're running out of time, I'm going to have to just show this to you here all at once instead of step by step. In fact, I'm going to take this pointer off. So we entered below here, right there. Okay, look how far this went down. Went down pretty nice, like about 7 points. That's 28 ticks. That's not a bad move. It's pretty good. However, if we, oops, gosh, that's why I took the global crosshairs off. Okay, if we look over here at our setup chart, look what happens. All it did was move from there to there, right? We took this reversal off of a failed wave 9, and it was a good, good setup. It was reasonable. It was a reasonable trade. This trade failed. This trade failed. And then we go up and we make higher highs. Well, that's the end of the day there anyway. Okay, so the trade actually failed. But did it make money? Yes, it made money. This is one of the things that I love about using the long-term chart as our setup chart, the Eagle Eye, is because even, it's a matter of perspective or scaling. Even though the move from, we'll just go from high to low, from there to there is not much based on this. And then it goes up and makes higher highs, and, the trade fails, right? Normally that would be a complete failure of a pattern. But because we're entering based on the short-term chart, it goes all the way down here. So, from like 360 and a half, 3460 and a half, 3467 or so, plenty of money to be made there on just a little retrace. Really doesn't break at the 15 EMA and then goes up and makes a higher high. So you can make money on failed trades when you use this approach. And that's one thing I love about it. The second is you will often get two opportunities to get an entry, as I said, because of the 9-to-1 ratio between the short-term and the long-term chart. The downside of the Eagle Eye approach, let's actually just bring this up and demonstrate it here, is a couple of things. Number one, you're just not going to get that many trades a day, right? Because you're not going to get that many setups. So let's look at this here. Okay, I can bring this all the way across here. Alright, that's pretty good. We'll just do this. So this day, do we get many setups? Well, that's a nice setup there. 1, 2. Again, the stochastic doesn't get down to the 20 though. So, again, you would have to be aggressive with that, or you would get no Eagle Eye trades that day. That's the one we just looked at and that we took. So, see, here's the thing. We get into a mega trend, don't we? We get into a mega trend. So, well, actually, yeah, we do. We get into a mega trend. And we get no reload patterns. So, no really perfect, fantastic trades for 3 days. Of course, this is Thanksgiving and the day after, so they're a little different. But that's one of the problems. So trading only the Eagle Eye style, you're not going to get very many trades every day. And you may get none some days. You will get none some days, I should say. You will get none some days. So that's really, I would say, the biggest disadvantage. And the other one that I pointed out already, but I'll just reiterate, is if you use your trailing stops under the swing, well, let's say cycle lows if you're going long, or wave lows, just like we made money on this little move down, okay? Well, if you're going to trail your stops under your cycle lows or your swing lows or your wave lows, the market's going to move against you a lot before it hits your stop. And that can be very unnerving psychologically. Again, it can move down, 6, 7, 8 points on the NQ. And you still haven't hit your stop. So, but that's really the only way to stay in for the really big moves. And even then you won't always stay in. I mean, look at this. Let's just be honest here and show you. We've got a megaphone pattern here. So this low, if you were to just trail under even a wave low, you would have gotten stopped out here. And then it went up. If you were to trail under a swing or a cycle low, let's say your cycle low here, well, you would have been stopped out, so you would have suffered a big loss here. Of course, you would have taken some profits. and then it still went back up. Now with this one, you would have been okay. So very tough. I can just tell you from personal experience, very challenging to your psychology to stay in there using this really wide trailing stops. But again, on the other hand, it's the only way to catch the really big moves. Now, if you were to trade this 5-wave pattern, you'd be okay. You would have been able to stay in. Because if you stayed under, that would be your trailing stop there, that would be your trailing stop there. And then when you get to your wave 5, you're out. And so in this case, you would have made, some really nice money. Made like 20 points or more. So just like everything, there's advantages, disadvantages. A lot of it just comes down to what you are comfortable with psychologically, what feels good to you, how often you want to trade, and some of it also comes down to the size of your trading account. Because with something like this, you need flexibility. You need to be trading, I would say, at least 4 contracts to really be able to take advantage of it, because you're still going to have to lock in profits when they're given to you. And because, again, you don't want those big drawdowns.